The Consumer Financial Protection Bureau, or the CFPB, is an independent federal agency whose mission is to help consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. My name is Zixta Martinez. I'm the Associate Director for External Affairs at the CFPB. Today's field hearing is being live streamed on our website at consumerfinance.gov, and you can follow CFPB on Twitter and Facebook. You can also file a consumer complaint at consumerfinance.gov by U.S. mail, by fax, or by calling 1-855-411-2372. That's 1-855-411-2372. I'm going to spend just a few minutes telling you about what you can expect at today's field hearing. First, you'll hear remarks from Director Cordray, who will talk about the Bureau's CARD Act report. Following the director's remarks, CFPB Assistant Director Marla Blow will lead a discussion with a panel of experts who will also talk about the impact of the CARD Act on this market. Assistant Director Marla Blow will be joined by the CFPB's Deputy Director, Steve Antonakis. Following the panel discussion is my favorite part, the audience participation portion of the field hearing. This audience participation portion is an opportunity for us to hear from you about what's going on in your community in the consumer finance markets. And our audience today includes community leaders, advocates, industry representatives, and of course, consumers. Our audience also includes the members of the CFPB's Credit Union Advisory Council, which is holding its quarterly meeting here in Chicago. We also are pleased to welcome bipartisan congressional staff from the offices of Senator Mark Kirk, Congresswoman Jan Schakowsky, Congressman Luis Gutierrez, and Congressman Mike Quigley. Thank you all for joining us here today. So let's get started. I'm now very pleased to introduce Richard Cordray. Prior to his current role as the CFPB's first director, Richard Cordray led the CFPB's Enforcement Office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In this role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect consumers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. Director Cordray.
Thank you, Zixta. Thank you so much for all of you being here today, and I want to thank you especially because as I was sitting here, I noticed we've been here already for a time this morning that all of you somehow brought the sunshine with you today, so thank you. I'm always happy to be back in Chicago, where I spent 3 good years as a law student, and noting that this is the Harold Washington Public Library. I had a nice story about Harold Washington and the parrots of the south side of Chicago, but I will not belabor you with it here. We're hosting this field hearing to discuss the effects of the Credit Card Accountability, Responsibility, and Disclosure Act, a law commonly known as the CARD Act. The CARD Act was passed with the specific goal of making the credit card market fairer and more transparent for consumers. Today, we're releasing a report that Congress required us to prepare about the impact of the CARD Act on the marketplace. Before we discuss the results of our report, however, it's important to describe conditions in the marketplace when the CARD Act was signed into law. The economic landscape in May 2009 was quite poor. The housing market had crashed. Unemployment had risen to 9.4%. A whopping 14.5 million people were out of work, and that number was expected to continue to grow. Gross domestic product had moved sharply into negative territory, falling by 8.3% and 5.4% in the previous 2 quarters, and the Federal Reserve was predicting it would drop even further. At that time, I was serving as Ohio's Attorney General, and we saw firsthand how hard people were struggling to stay afloat. Particularly with respect to credit cards, people were extremely frustrated, and they were complaining loudly and frequently about being dinged by unexpected fees and about dealing with card agreements full of fine print and legalese they could not decipher or understand. The bottom line at the time was that consumers had no good way to assess the true cost of their credit card up front. Some members of Congress became interested in how to address the challenges raised by their constituents, and the Federal Reserve had swung into action to develop some new rules in this area. Against that backdrop, Congress passed the CARD Act to address troublesome practices and reform the credit card markets. One problem that consumers faced was hidden, excessive, and unfair fees. These fees made it hard for consumers to anticipate costs. In some cases, they could not avoid these fees and did not know they were coming. Maybe a consumer's check payment was due on a holiday and there was no mail delivery, so the check was not received in time. Or maybe the consumer unwittingly spent more than the credit line. Some consumers set up mechanisms to pay their bills regularly, but were ambushed when payment due dates changed from month to month. In these cases, the consumer would be charged an unexpected fee. The CARD Act took action to address each of these problems. The law set standards for when late fees can be assessed. Congress established that credit card bills must be due on the same date each month, and that card issuers generally cannot charge a late fee unless consumers are given at least 21 days to pay their bill. The law also established limits on how much can be charged in late fees. As a result, we found that the average size of late fees declined since the passage of the CARD Act. Based on the credit card accounts we studied, representing most of the market, we estimate that the average late fee decreased by $6 after the CARD Act took effect. That means these consumers paid $1.5 billion less in late fees in 2012 than they would have paid had late fees remained at their pre-CARD Act levels. The CARD Act also tackled over-limit fees, which often surprised those consumers who had no idea they'd spent past their credit limit. Prior to the law, card issuers could charge a fee for transactions that put cardholders over their credit limit, and each over-limit transaction could result in an additional fee. The CARD Act barred companies from charging a fee to cardholders who exceed their credit limit unless the cardholder has affirmatively opted in to pay over-limit fees. Additionally, card issuers can no longer charge more than one over-limit fee during a billing cycle. With these changes, over-limit fees have been largely eliminated as a source of cost to consumers and revenue to issuers. Based on the credit card accounts that we studied, we estimate that if everything else had remained equal except for the changes made by the CARD Act, those consumers would have paid about $2.5 billion more in over-limit fees in 2012 than they actually paid. We did find that annual fees and interest rates have increased since 2008, which indicates a shift from hidden back-end pricing toward more transparent front-end pricing that consumers can understand and evaluate more easily. Even more significantly, however, we found that the total cost of credit, which includes all fees and finance charges, declined between 2008 and 2012 by 2 percentage points. Consumers were also struggling with a lack of transparency when it came to their credit cards. Credit card agreements were long and difficult to understand. These agreements often contained provisions which allowed the credit card issuer to hike the rate if the consumer tripped any of several complicated wires, including the notorious universal default. Cardholders would open their monthly statement and be surprised to find that their interest rate had jumped. Credit card agreements also allowed issuers to change the terms at any time and for any reason, and the new terms could be applied to existing balances. Such price changes made it difficult for consumers to predict the cost of their credit card and manage their finances accordingly. The CARD Act sought to make credit card costs clearer to consumers, and we found that it dramatically improved overall transparency in the market. In order to address unexpected interest rate hikes, the CARD Act generally stopped card issuers from increasing the interest rate on an existing balance unless the cardholder has missed 2 consecutive payments. The law also added new requirements for monthly statements. Now the statements must include useful information like how long it will take to pay off the bill if the consumer pays only the minimum amount due, and how much doing so will cost the consumer. These disclosures give consumers a clearer sense of the consequences in deciding how to handle their credit card payments. The CARD Act's new disclosure requirements and the end of surprise interest rate increases resulted in a market where pricing is more predictable and transparent for consumers. In this market, shopping for a credit card and comparing costs are far more straightforward. And every credit card user can now make a purchase, confident that when the bill comes due, the interest rate will not have skyrocketed without notice. They can count on the fact that if they make their payments on time, the terms of the deal they made at the time of purchase are the terms of the deal they will live with over time. We also determined that credit card contracts have become shorter and easier to understand in recent years. Our report showed that the card agreements we studied from the largest card issuers have decreased by more than 2,000 words on average, and that readability has gone up, making the market somewhat more transparent and accessible for consumers. This is not something the CARD Act required, but it is something we've been urging in order to help consumers process the key information more easily so they can know before they owe. Many card issuers have chosen to embrace the spirit of the new law in this respect. We applaud those who are making this effort. We will continue to push others to follow their lead and make further changes, and we remain willing to work with credit card issuers in finding ways to serve their consumers better. Consumers have responded positively to these market-wide changes. When J.D. Power released its 2013 U.S. credit card satisfaction study, it showed credit card satisfaction is at an all-time high since the study was first conducted. Significantly, the study concluded that overall, customers appear to be increasingly happy with their credit cards, and J.D. Power explicitly attributed some of that satisfaction to the CARD Act. We also believe that the increasing satisfaction customers are expressing about their credit cards reflects the manner in which some issuers have intensified their focus on customer complaints. More operations are prioritizing and incentivizing efforts to remediate individual complaints and to analyze and respond to patterns in the complaints they receive. These are powerful market developments that naturally improve customer service and customer loyalty. They also pay tangible dividends by reducing legal risk, reputational risk, and regulatory risk. Needless to say, we're very much supportive of these trends. In order to get a complete view of changes in the credit card market, we also examined the overall availability of credit. Credit availability started declining in 2008, before the CARD Act had even passed, but after the financial crisis had begun, and by most measures began to rebound in 2009. This is not surprising. Credit is known to be cyclical, and the nation's economy was experiencing its sharpest downturn in decades. So as the crisis hit, credit losses ensued, and creditors implemented more restrictive credit standards. Even with the changes that occurred during these unusual economic conditions, consumers with credit cards still have plenty of available credit overall. In fact, there's currently about $2 trillion worth of unused credit in the market. The CARD Act has provisions that were explicitly designed to better protect young consumers from getting credit cards they cannot afford. In the years prior to the CARD Act, it was often too easy for students to rack up credit card debt they could not pay back and damage their credit rating for years to come. When I was serving as the treasurer of Ohio, I heard many bitter complaints from parents about the aggressive marketing practices on college campuses that targeted naive 18-year-olds just away from home for the first time. With the CARD Act, consumers under the age of 21 cannot get a credit card unless they can demonstrate an independent ability to repay the debt or unless they have a cosigner over the age of 21. Our report found that the number of credit card holders under 21 has been cut in half in recent years. This decrease, which contributes to the decline in available credit, is an intended consequence of the CARD Act and is good news in promoting responsible access to credit. We've seen two other factors that may be contributing to the dip in available credit. First, we've seen a notable drop in the number of consumers who receive unsolicited credit line limit increases on their accounts, meaning that more consumers have to ask for their credit limit to be raised rather than having it happen automatically. Second, the ability to repay provisions in the new law have had at least a modest effect on credit availability. We've seen that at least a small slice of customers whom card issuers may deem to be creditworthy have been declined for credit cards because they cannot prove they have the means to pay back the potential debt. We addressed one such issue that came to our attention by issuing a new regulation earlier this year. This rule made it easier for stay-at-home spouses or partners to get their own card if they have access to resources that allow them to make payments. Consumers need access to credit. We simply want to ensure they have responsible access to credit. Although the CARD Act effectively addressed many problematic practices in the market, we do highlight a number of outstanding concerns in our report. One area of concern is credit card add-on products, which have seen firsthand how the deceptive marketing of these products can harm consumers. The Bureau has already issued a bulletin to put issuers on notice of these problems, and we brought several enforcement actions that have put more than $700 million back in the pocket of consumers. We will continue to use both our supervisory and enforcement authorities to protect consumers by rooting out unfair, deceptive, or abusive acts or practices. Second, we recognize that some card issuers charge upfront fees that exceed 25% of the initial credit limit, which is the cap on fees that the CARD Act sought to impose. But those practices have been held not to be covered by the law because a portion of the fees are paid prior to account opening. We plan to keep a close eye on how card issuers use application fees in connection with opening accounts, and we will determine if we should take action under our available authorities. Third, we plan to study the impact of deferred interest products. These are credit cards that come with a 0% interest rate, but with a catch. If the balance is not paid in full by a certain time, the company will assess interest retroactively. The data we've obtained indicates that over 40% of borrowers with subprime credit histories end up being charged retroactive interest. We will be examining the risks and benefits of such products, and we will take action if it appears to be justified. Fourth, we've identified a number of areas in which transparency concerns remain. One of these areas relates to online disclosures. While the CARD Act requires certain disclosures to appear on monthly statements, those consumers who pay their bills online may never see the disclosures. We will be monitoring the steps that card issuers take to provide consumers with these beneficial disclosures when they access their accounts in different ways. And there's a more general issue for the Bureau in terms of how to handle online disclosures generally that we're thinking hard about. Fifth, we're concerned about the quality of disclosures that are made about rewards products. Many consumers are picking their credit cards based on rewards programs. These offers, however, can be highly complex, as consumers may face detailed and confusing rules about how they can actually use their rewards. We will be reviewing whether rewards disclosures are being made in a clear and transparent manner, and we will consider whether additional protections are needed. Lastly, we're concerned about the disclosures used to inform consumers about grace periods. Most cards allow consumers to avoid paying interest on purchases when they pay their balance in full each month. This period between the end of a billing cycle and the payment due date is called the grace period. We want to make sure that consumers know that once they carry a credit card balance into a new month, they no longer have a grace period on new purchases. While we've not yet studied the level of consumer understanding about grace periods and how they work, it's an area that merits our future attention. Our CARD Act report was a comprehensive undertaking, which showed that on the whole, the CARD Act accomplished a number of its intended goals. Based on the information we have available to review changes in the credit card market, the Act eliminated many unfair fees, made some market practices more transparent, paved the way for easier comparison shopping, and created a market where consumers can see the costs up front. These changes are critical to strengthening consumer protections in the marketplace and helping us rebuild our economy. Today's report was based on extensive research. We looked at data spanning the period from before the law was passed through December 2012. To dispel any myths, let me just say that we used anonymized industry data to better understand how the markets are working. We never receive a cardholder's name or other direct or unique identifiers. We never receive information describing the specific transactions on any account, and we do not monitor any individual's financial transactions. We're interested only in market trends, and as a result, the data is limited to items like interest rates, account balances, total purchases, total payments, and fees charged to consumers. In fact, for purposes of this report, industry participants submitted to us analyses they developed from similar data. Without all of this information, we would not be able to study the market, to understand the benefits of the CARD Act, and to flag areas of possible risk to consumers. In short, we would not be effective in carrying out the responsibility to report to Congress and to the American public. Today, I'm looking forward to vigorous discussions about the state of the credit card market and the impact of the CARD Act on both consumers and the industry. Thank you all for joining us.
Thank you, Director Cordray. At this time, I'd like to invite Deputy Director Steve Antonakis, Assistant Director Marla Blow, and our distinguished panelists to please take the stage. As the panelists are making their way to the stage, I'm just going to take a moment to thank those joining us by live stream and to remind folks that they can follow us via Twitter or Facebook. And you can also file a consumer complaint at consumerfinance.gov by U.S. mail, by fax, or by calling 1-855-411-2372. Before we get started with our panel discussion, let me introduce Marla and Steve. Marla Blow is the Assistant Director of the Card and Payment Markets Office at the CFPB. She joined the Bureau in January 2011, following 8 years at Capital One. Her experience at Capital One included work in the risk management, finance, marketing, and corporate development teams. Before joining Cap One, she held a variety of capital markets and investment banking roles on Wall Street. Also joining today's panel discussion is Steve Antonakis. Steve Antonakis joined the CFPB in November of 2010 as the Assistant Director of Large Bank Supervision and was named the Associate Director for Supervision, Enforcement, and Fair Lending in June 2012. His background includes more than 2 decades as a financial services regulator. In September, he was also named CFPB's Deputy Director, along with his continuing role as Associate Director for Supervision, Enforcement, and Fair Lending. Marla and Steve, you have the floor.
Good morning. It's a pleasure to be here and in this beautiful space. I'm appreciating Chicago. And I just want to do a little bit to frame up the conversation and then introduce the panelists. And then we'll begin with some questions and give the panelists an opportunity to make some opening statements and opening remarks. And then we will proceed with the conversation. But I just want to lay the groundwork for why we did this report. As Director Cordray mentioned, it was required in the statute. It is something that we will be doing every 2 years. But this is the first one, and it's timed to coincide with 2 years from the last major implementation date of the ability to pay provision of the CARD Act. And that timing was October of 2011. So as a result, we targeted releasing our report October of 2013, and here we are today. There were specific topics that were listed in the statute as areas that we needed to contemplate and look into and report on. They were the terms of credit card agreements and the practices of credit card issuers and how they've changed in the wake of the CARD Act. It's the effectiveness of disclosure. One of the big parts of the CARD Act was some new disclosure requirements, and we did what we could to look at the impact of those disclosures. The adequacy of protections against unfair deceptive practices. Director Cordray called out a number of the areas that are still remaining concerns. Those are the things that we identified as a result of taking a look at what we thought the adequacy of protection is today. The extent to which and whether the implementation of the Act has had an effect in a number of areas. One, on the cost of credit, and that is whether there's been any meaningful increase in particular, right? That credit, one of the big criticisms of the CARD Act was that it would make credit more expensive, that consumers would end up actually having to pay more. And one of the things that we, as mentioned, have already determined is that, in fact, that was one of the things we did not observe, that on a per dollar borrowed basis, consumers actually are paying less. And that is driven primarily by the limitation on penalty fees. We'll have an opportunity to talk about that potentially in a little bit more detail. In addition to that, we were asked to look into the availability of credit. One of the other charges was, with all these changes brought about by the CARD Act, there will be less credit, period. We mentioned earlier there has been a change in the availability of credit, there has been a reduction, but credit remains plentiful, and unused credit line still stands at $2 trillion, as mentioned. And importantly, about $40 billion of that $2 trillion is available to consumers with subprime credit scores. So again, that market was an area where there were significant expressions of concern that that is a place where there will be the most sort of disproportionate impact. But with $40 billion still of unused credit available in that space, there is still certainly activity there. We were asked to look at the use of risk-based pricing, which is a practice of assigning interest rates on the basis of the creditworthiness of the applicant. And we found that risk-based pricing actually does continue. And there's more detail, but the part of the concern was that this would require some standardization, or that everybody would need to get the same interest rate, and that would in effect raise interest rates, particularly for consumers that had better credit scores. And what we found is that risk-based pricing actually does continue, and that there's still ample stratification of the credit card market. And then the last thing we were asked to look at was innovation. And one of the charges was that the CARD Act would essentially put a lid or sort of quell innovation in this industry. And we make some remarks on that. Innovation is a difficult thing to measure, and it's somewhat in the eye of the beholder. But we did take a look at some of the things that have changed and the ways in which the credit card market has capitalized on social media, new technologies, other opportunities in the market to really change and innovate around communication and interaction with consumers. So that's a high level, sort of those are the topical areas in the report and very high level findings of what you can find in there. Let me turn to introducing the panelists and thank everybody for joining us. I will start with Lauren Saunders, who's on my left, your right. Lauren's the managing attorney at the National Consumer Law Center, where she handles legislative, administrative, and other advocacy efforts in the financial services area. She's testified before Congress and contributes to several NCLC manuals, including consumer banking and payments law, fair credit reporting, fair debt collection, and foreclosures. She previously directed the Federal Rights Project of the National Senior Citizens Law Center, was Deputy Director of Litigation at
Betzedek Legal Services.
Betzedek Legal Services, thank you, I apologize, and was an associate at the public interest firm Hall and Phillips. She graduated from Harvard Law School, where she was executive editor of the Law Review and holds a master's degree in public policy from the Kennedy School, as well as a BA from Stanford University. Thank you, Lauren, for joining us. David Yen, right next to Lauren, supervisory attorney at the Legal Assistance Foundation of Chicago. David serves as supervisory attorney for Legal Assistance Foundation of Chicago. He previously worked for Legal Services Corporation of Alabama, which is now known as Legal Services Alabama. He specializes in bankruptcy cases and is a graduate of the University of Pennsylvania. Ed Mierzwinski, I apologize, has been a consumer advocate in the Washington, D.C.-based federal lobbying office of the National Association of State Public Interest Research Groups since 1989. He frequently testifies before both Congress and state legislatures and has authored or co-authored numerous major reports on a wide range of consumer issues, including financial reform, cable television rates, telecommunications reform, banking, financial services, and identity theft and product safety issues, including toy and playground safety. Mr. Mierzwinski is a founding member of the Transatlantic Consumer Dialogue and represents U.S. PIRG on the TACD Steering Committee. Turning to the other side of the panel, on the far right, we have Sanjay Sakrani. Mr. Sakrani covers the diversified financial sector with specific focus on credit card issuing and payments companies at Keefe, Bruyette & Woods. Prior to KBW, Mr. Sakrani was at Callion Securities, where he followed the specialty and mortgage finance sectors. He also spent 5 years within Citigroup's U.S. Equity Research Department's specialty and mortgage finance team. He has a BS in finance from St. John's University and an MBA from Cornell. Mr. Sakrani has been recognized as one of the leading analysts in the consumer finance industry. He took the top spot in Institutional Investor's All-America Research team in 2012 after finishing as a runner-up in the prior year. He has also been named a top stock picker in Wall Street Journal's Best on Street survey and placed prominently in recent Greenwich Associates annual rankings. Next to Sanjay, we have Mary Dunn. Mary Dunn is the Senior Vice President and Deputy General Counsel in the Credit Union National Association's Washington, D.C. offices. Ms. Dunn is the Chief Staff Liaison to CUNA's Examination and Supervision Subcommittee and to the CUNA Federal Credit Union Subcommittee. She's also a liaison to the CUNA Governmental Affairs Committee and Community Credit Union Committee. She writes a bi-monthly column for CUNA's Credit Union magazine and oversees the production of CUNA's RegWatch and regulatory analyses on all proposed and final regulations affecting credit unions, as well as Operation Comment, CUNA's website to facilitate comments from the credit union community to regulators. And next to Zixta, we have Bill Johnson. Bill is the CEO of Citi Retail Services, the division of Citi's global consumer banking business that provides consumer and commercial credit card products, services, and integrated retail solutions to national and regional retailers across the United States. The business services nearly 90 million accounts for a number of iconic brands, including the Home Depot, Macy's, Sears, Shell, and ExxonMobil, among others. Mr. Johnson is also responsible for the operational risk management and risk operations, functional utilities supporting all 4 of Citi's North American consumer businesses. These utilities, which focus on driving effectiveness and efficiency while protecting the Citi franchise, were established in May of 2013. Please join me in welcoming all the panelists.
At this time, we want to invite the panelists to just give us a very quick overview of their general observation in connection to our CARD Act. And why don't we start with Lauren, and then we'll kick it off with Sanjay.
Okay. Thank you for the opportunity to be here today and to talk to you all about this very thorough and very interesting evaluation of the Credit Card Act. I worked on the Credit Card Act along with a number of other people. I'm sorry?
Pull your mic closer.
And it is so helpful to have this report to be able to look back retrospectively at its impact. And I can say that, I think it really shows how the absence of smart regulation to protect consumers can at times lead to a race to the bottom and the wrong kinds of competition, and that the presence of smart regulation helps everybody, both consumers and the industry. Before the Credit Card Act was passed, there was this race to the bottom, all sorts of competition at the front end about APRs or rewards, but at the back end, a lot of people were trying to figure out how to ding consumers with back end fees, retroactive interest rate hikes, and other manipulations that consumers didn't really understand. Not only did these practices harm consumers, they also harmed the better players in the industry who tried to avoid them because they didn't get the benefit of doing something in a straight, honest way if their competitors were making a lot of money by engaging in tricks. Citi, for example, announced that it would not hike interest rates for consumers who were paying on time just because something else happened in the rest of their market. And yet the rest of the industry, for the most part, didn't follow that, an obscure issue that consumers couldn't understand. So, we think that it's definitely helped people to understand their cards and shows how regulation can work.
Thanks, Lauren. David?
Let me just offer a disclaimer. So the opinions that I give are my personal opinions and not those of the Legal Assistance Foundation. So one of the most common kinds of cases that we see are credit card collection cases. And in that context, it's always been hard to know exactly why the consumer is in that fix. Was it because of some abusive problem, or was it just misfortune or overextension of credit? On top of that, in recent years, we have seen a lot of lawsuits brought by debt buyers, so that it's even harder to figure out why the lawsuit is being brought, because sometimes they don't even owe the money or they don't understand where the debt came from. But that said, I do think that we've seen fewer cases where we can identify these sorts of abuses that were addressed by the CARD Act as being the cause of the default. So, you know, it seems that our anecdotal evidence coincides with what's in this report. At the other end, we have clients. I talk to clients who don't have credit cards, and a lot of them don't want to get credit cards because of the things that either they've experienced or that they've heard about the ways you can be tricked into getting in over your head. And one unfortunate side effect of that is that they're more vulnerable when they do have a financial crisis. They don't have a credit card already, and they go to the worst credit providers. And if any of those are in the room, I don't mind offending them. You know, the payday lenders, the title lenders, and some of the really other kind of below subprime products. So if there's any way that, you know, if the market has improved as much as it seems to have, I hope that eventually, you know, my clients will be willing to get back into the credit card pool because the other alternatives are so much worse.
Thanks, David. Ed?
Thank you, Zixta. And as Marla said, I came to Washington in 1989, and credit card problems existed in the 1990s, and credit cards were extremely profitable throughout the 1990s. The Federal Reserve does an annual report to Congress, credit cards, most profitable form of bank lending, end of story. But in 1999, there was a culture change, in my opinion, when Congress deregulated banking and the Wall Street boys came in and said, every year you've got to make even bigger profits in every division. And so the credit card companies really started to ratchet down the thumb screws, as Director Cordray described some of the practices. First, they went after the late pays. Nobody cares about late pays. They simply said to the late pays, a late fee is not good enough. We're going to triple your interest rate. Now do the math. If a credit card has a 2% minimum payment, that's approximately what they've always been, but the interest rate is raised to 36%. Divide that by 12, that's 3% a month. Your interest is going up 3%, and if you're only able to afford the minimum 2%, you're losing ground. You're ratcheting up credit card debt. Then they said, well, let's have more people pay late, so let's trick them into paying late. And the director articulated a number of the things they did, making bills due on a Sunday, saying that a bill that arrived after 11 a.m. was late, changing the due date, et cetera, tightening the period between when a bill was sent and when it was due. And that was a big moneymaker for the credit card companies. But we couldn't get Congress to listen. From 1999 to 2004, I can only recall 2 hearings on credit cards. And we couldn't even get a vote on a bill. We had bills. We couldn't even get a vote on a bill that we would, of course, lose to try to fix the system. But then the credit card companies started to overreach. They invented what the director called universal default. They said, even if you've never been late to us, we're going to raise your rates. Again, retroactive rate increase on your existing balance to 30 or 36% if you've been late to someone else. And then in 2005, to show you the power of the credit card industry, despite the heroic efforts of a coalition of labor, civil rights, consumer, and other organizations with the help of Professor Elizabeth Warren, the Congress gave the credit card industry this awful bankruptcy bill that allowed them to collect more money from people who didn't have it to pay them. But then the credit card industry made its biggest mistake, and that was to invoke the we can change the rules at any time for any reason, including no reason clause. They raised everybody's rates. And against the backdrop of the financial crisis in 2006, 2007, we finally got the leverage to pass the act. It is an example of good legislation, good regulation that works to better align the interests of the producers in the market with the consumers in the market. And now we're fortunate we have the CFPB to enforce the law.
Thanks, Ed. Sanjay?
Thank
you and good morning. My name is Sanjay Sakrani. I echo the previous remarks. I think the update report was very thorough and informative. Just to give you guys some context as to what I do for a living, I consult with the investment community on the fundamentals of the credit card industry. Having analyzed the credit card space for about 12 years, I think the CARD Act was certainly a piece of legislation that was very unique in relative to other rules that have come out over time, in that it aimed to eliminate a number of very favorable profitability practices for the credit card industry. While there are other aspects to the law, I'd say the key areas that impacted the issuers from a fundamental perspective were as follows, based on our opinion. The significantly diminished ability to reprice customers, the elimination of double cycle billing, over-limit fee option being abolished or substantially curbed, and caps being applied to late fees. I think the impacts that have been apparent to us, both in analyzing the industry and listening to the key players in the industry, are as follows. First, I think the overarching theme was that it leveled the playing field across the space. Given the diminished ability to reprice individuals relatively dynamically based on their credit performance and across multiple products, issuers basically bridged the gap by raising APRs or yields fairly unilaterally across their customers, with almost a steeper increase being seen among their better customers. So I think the disparities between APRs across segments narrowed. When looking at some of the competitive forces at play pre-CARD Act, like teaser rates, I think the teaser rates have become less prevalent and significantly less lucrative to higher-end consumers. As far as the impacts from diminished pricing flexibility and lower fee income, we think there's two major impacts. One, it certainly led to more rational pricing and less irrational competition, particularly as it relates to teaser rates. Second, I think there's still some empirical evidence that the issuer's appetite to lend to certain segments of the market have been meaningfully curbed relative to pre-CARD Act. As far as economic impacts to the card issuing space, I think it's clear the companies have priced in the worst case scenario, and today credit quality is pretty favorable, so I think the profitability is high. But I think one should be very aware that the investment community, as well as ourselves, are aware of the fact that when the economy turns for the worse, the profitability or lack thereof will be significantly worse than we've seen in the past. When you think about, I'm sorry, and then I'll stop there. Thank you.
Mary?
Yes, thank you, Zixta, and good morning, and thank you, Director Cordray and Deputy Director Antonakis. It's really a privilege and a pleasure to be with you today. I'm kind of blinded by the sun, so I can't really see any of you out there, so if you're scowling at me or you're asleep, I really can't tell, so I'll just continue on with my comments, though. But it is a pleasure and a privilege to be here. Every time we get an opportunity to have policymakers in the room, we like to talk about the distinctions that make credit unions unique, particularly with the Credit Union Advisory Council sitting there on the second row and so many friends there. But I think it's very relevant for the discussion this morning. Credit unions don't view themselves as part of the credit card industry. We view ourselves as cooperatively owned financial institutions that provide credit cards and other services because our members want them. Having said that, we do support and appreciate the proactive role that the CFPB has taken in implementing the CARD Act, and I'm going to talk a little bit more about that in just a minute. Credit unions are unique, though, because of many factors. One of them is the way that credit unions by law can build their capital. Every financial institution to stay in business has to have capital. Credit unions can only build capital through retained earnings, which includes things like fees. There are costs associated with credit card programs and other services that credit unions provide their members. Nonetheless, despite pressures to build capital from regulators and others, credit unions work very hard to keep their costs down, including on credit cards. I've got a lot of statistics that I could share with you, But bottom line, on a non-rewards card program, a consumer that uses a credit union is going to save about $100 a year with that credit card program. That's a big savings, and that's important to all of us. We do appreciate that the CFPB has proactively, as I said before, implemented the CARD Act. CUNA, the Credit Union National Association, which I represent, which represents credit unions across the country, supported the objectives of the CARD Act. And we do appreciate, as the director reported today, that the act is working. There are many... Bill?
Thank you. Pleasure to be here. Appreciate the invitation and the opportunity to speak on our views around the CARD Act. City's committed to earning our customers' trust by offering excellent service, solutions that simplify their financial lives, and financial products that create real value. Credit cards offer customers convenience and protections that they cannot get with cash, whether it's filling the tank quickly, building up a credit history, or replacing that broken appliance that wasn't expected. We deliver value day in and day out. Fundamentally, we at Citi, and I believe the industry overall, fundamentally strive to provide our customers with easy-to-use credit tools to help them manage their lives. To that end, we support the CARD Act in its efforts to create consistent, understandable rules for the credit card industry. It's our belief that the Credit Card Act has generally improved the credit environment for consumers by increasing transparency to the cost of credit through better and more consistent disclosures, and in creating consistency in the application and assessment of certain fees, such as over-limit and late fees. However, I think as noted in the CFPB's report, it is difficult to discern the impact of the CARD Act on the cost of credit or on the availability of the credit, as the data is open to different interpretations and the time period involved was extremely volatile. The industry underwent significant change. The CARD Act itself, multiple accounting changes, the Great Recession and the economic effects of that and high unemployment, and the increasing capital requirements. It will be some time before we better understand the cyclical and permanent changes that have occurred and more clearly determine the cause and effect. That said, we believe that a good relationship with the CFPB is in the interest of the industry and the better public policy. The best example of this is the CFPB's recent efforts in the area of ability to pay. I think that's an area where the industry and provided the appropriate data and instance of issues in which the CFPB responded, and the changes worked. We believe that continued collaboration with CFPB benefits consumers and the industry. A balanced approach that focuses on consumer protection and creating broad, equitable access for every customer can be achieved through a thoughtful working relationship that fosters ongoing discussion and seeking solutions that benefits all parties.
Thank you, Bill.
Great. So good morning. Good morning, everyone. Thank you for coming. I want to thank our panelists especially. My first question is for Sanjay, Mary, and Bill. And I would ask you all to take a few moments to describe the state of competition in the credit card market today. On what features are participants competing, and in your views, to that regard, what features do you choose to highlight, and which of these features resonate the most with your consumers? So really, first and foremost, talk about competition in the credit card market and what features you believe are most important. Sanjay, we can start with you.
I guess what I mentioned in my prepared remarks was there is empirical evidence that the credit card companies are focusing away from certain segments into others. And I think one of the prominent trends we've seen is the issuers are really focused on the transactor, super prime-oriented, good credit customers. So there's a lot of competition in the reward space by virtue of that. I think secondarily, where there is a propensity to want to lend to consumers, I think you've seen issuers compete and market products that are specific to pricing transparency. So some examples of that are Discover It and Citi's Simplicity Card. I think those are cards that kind of market themselves as being very convenient and price conscious to consumers. So I think that's where we're seeing a lot of the marketing offers in terms of the lenders, and I think that's what's resonating well with consumers because you're actually seeing growth in those segments.
Yes, well, credit unions really don't see themselves as competing with banks, for example, in the credit card space. What they are trying to do is look for ways to offer programs that their members will benefit from. And they do that by looking at the fees and the terms. Rates have crept up a little bit, but credit unions have really tried hard to minimize those fees wherever possible. And I think that's one of the biggest values that credit unions can offer.
Generally, competition remains relatively robust in that everybody continues to participate and pursue growth. At the same time, comparative to past years, it's constrained. It's constrained as the revenue streams that had previously existed have fallen away, and as the issuers have had to change a focus around this new regulatory and operational controlled environment, where we've invested significantly in those areas. I think the areas in which we compete continue to be primarily around rates and in rewards and the traditional benefits. One of the things I know the industry is looking at, and as you see more of, is looking for an emotional connection with customers. What are the things that excite them? What are the things that cause them to act and behave in a way that we can create and deepen our relationships with them? We don't see our customers as just purely a transaction, but as a customer with which we want to build a deeper, broader relationship and service them with the right products.
Great. Thank you.
So I'm going to ask a question of the consumer advocates panel, and David, this one's specifically for you. How would you describe the satisfaction level of consumers with their credit cards, and has that changed over time? And if you could have any insight or thought on what might have led to those changes, what might be driving changes in consumer satisfaction with credit cards?
Well, I think I'm somewhat handicapped because most of my clients, well, all of my clients are either low income or elderly, and I think a lot of them have been self-selected or selected by the credit card companies. The ones who were sort of marginal, they couldn't keep up their relationship with the credit card. So the clients I have who still have credit cards are pretty happy with them, but I think a lot of my clients 2 or 3 or 4 years ago were just on the edge, and that any little thing would push them to the point where they couldn't keep up with it. As I said before, I don't see a lot of the low-income clients entering the credit card market again. I think they think they're not going to get a credit card, so they don't even bother applying.
Okay, thank you.
This next question is for Sanjay. What do you see as an opportunity for innovation in this market, and what has been the most compelling recent innovation?
Mm-hmm. Well, I mean, the credit card technology is a very mature one, and I think the problem has been, when thinking about making changes, whether or not the benefits outweigh the costs associated with making changes. It's pretty simple to go out and swipe a card and walk away and purchase something. So I think that's been the biggest precluder for innovation. But I think some areas where there has been some innovation has been around data security. Obviously, what's happening in the United States is we're moving, I believe, to EMV technology. So chip-based technology that's used internationally is moving to the United States. And I think the argument for it has been that fraud will find its way to the area where there's the least resistance. And today, it's the United States, which is relatively less secure because we don't use the chip technology and other countries do. So I think we're seeing some innovation around data security and enhancements in cards. There's this whole idea of tokenization, which is given the increased prominence of electronic transactions, card issuers and networks are working together to try to make it easier for people to transact online. And I think another area where there's innovation from the issuers as well as the networks that work with the issuers is around digital wallets and using data for marketing and loyalty-based programs. So I think using the data that they collect from consumers with their permissions, obviously, and utilizing it for their benefits and giving them more value, I think is an area that the issuers are definitely looking into.
Thanks, Sanjay.
And in your view, which aspect of the CARD Act has had the greatest positive impact on consumers?
Well, Steve, first of all, I'll just give a two-part answer. I didn't talk before about the benefits to students of the student provisions. As a group that did a lot of work in identifying unfair campus marketing, we were very pleased to find that the report found that those provisions work. But I think the most important provision of the CARD Act is the package of provisions that make it easier to pay your bill on time and prevent banks from unfairly, retroactively charging higher interest rates to your current balance. That package is very important and has really helped consumers.
Right. Thank you.
Bill, question for you. How has consumer behavior changed? So as in your observations post-CARD Act, in particular, do you see changes in consumer payments or in other ways in which consumers are using credit cards?
You know, it's a mix. Using the CFPB's definition of prime, super prime, what we've seen is in subprime. The superprime customer re-entered the market and began spending about 18 to 24 months ago. And they spent pretty robustly and have continued to return, continue to spend. What we find is that the prime and subprime customers have been constrained. They've not been spending at the same levels they did previously. And they had not, up until the last 90 days, shown any recovery there. Now, whether that is a byproduct of the CARD Act or the recession, I think that's for brighter minds to determine, to go through there. I would say that as the economy stabilizes, consumer confidence has improved, and the home values have stabilized as well, we see some early indications that customer, the prime and the subprime customer, starting to come back in and spend a little bit. As it specifically relates to payment rates, I think we often think about payment rates in terms of the amount of payment relative to the size of the outstanding. In my experience, customers don't budget that way. They budget as to pay how they can afford. And there's ample evidence that their payment behavior has continued to be relatively constant. The amount of their monthly payments has not changed materially. However, as a percentage of the outstanding balance, absent the spend, it has increased. So you'd see a payment rate increase, but don't believe that's an intent to increase payment rate as much as it is the budgeted amount that I normally pay is just a growing percentage of my outstanding balance as I don't replenish my payment with new spend. But again, in the last 90 days, there's been some evidence that we would say that the subprime and the prime customer are beginning to re-engage in the marketplace.
Great, thank you.
All of the panelists have either directly or indirectly touched on this question, but I wondered if Lauren could share some additional specificity here. What do you think is the biggest remaining consumer protection concern in the credit card market?
Certainly, overall, consumers are much happier with their credit cards, and you can see that on a number of levels. Surveys like J.D. Power's show better satisfaction. Complaints to consumer advocacy organizations are way down, and complaints to customer service offices and the credit card companies themselves, reflect, much better satisfaction. That said, of course, the market is not perfect, and there are still problems out there that need to be addressed. Your report touched on a number of those, and we agree that credit card add-on products, fee harvester cards, and deferred interest cards that hit people with a big retroactive interest payment if they miss that payment date remain big problems. But I would say the biggest overall problem is that it is still too easy to get way over your head in credit card debt and still too hard to get out of it. We've made some strides in that area, certainly better tailoring of credit to the younger adults based on their income has helped, and an overall ability to pay requirement has helped. But I think we need a bigger minimum payments so people can pay off their credit cards faster, more flexibility for people who get into trouble, and less marketing to people who are clearly over their heads and can't handle more credit.
Great. So I have the last question for the panel. It's from Mary. And Mary, I would ask for you to tell us, in your view, what the biggest challenges are for the credit union industry on a going forward basis.
So thank you, Steve. I actually think there are two. One of them is remaining nimble enough to provide the services that our members want when there's so many options out there in the marketplace. And so the second concern is really a concern that we share with, I think, the CFPB, and that is how to make sure that consumers are adequately, maybe even more than adequately protected, while at the same time allowing financial institutions to do their job to provide services in the marketplace.
What a terrific conversation we've had. It's been varied. Really appreciate it. At this time, I ask all the guest panelists to please rejoin the audience. We're about to start the audience participation part.
It's not going 6.
Looks like a mic is coming. Oh, there it is. Let me start all over. It's now time for our audience participation part. And a number of you have signed up to share comments, to share your observations, and really to tell us what you think. It's also a very important part of what the Bureau has been doing from the very beginning. We make it a point to get outside of Washington, D.C. and hear from folks directly. We want to know what's happening in your communities in the consumer finance market space. We have a few of you that have signed up. We typically encourage folks to spend about 2 minutes telling us their thoughts because we want to make sure that everyone who signed up has the opportunity to speak their mind. So I'm going to start with the first participant, Spencer Cowan. Chris or Julian will bring a mic to you.
Thank you, Director Cordray and the CFPB staff for holding this hearing on the Credit Card Act. I'm Spencer Cowan, Vice President of Research at Woodstock Institute, a research and advocacy nonprofit focused on issues of fair lending, wealth creation, and financial systems reform. The Card Act was passed to limit the worst practices of credit card issuers, and the report you released today demonstrates that it has succeeded in doing just that, limiting the worst practices. The Card Act's success is due in no small part to CFPB's commitment to holding credit card issuers accountable. We thank you for your enforcement actions against Chase for charging consumers for services they did not receive, and the action against Discover for deceptive marketing practices regarding add-on products. These enforcement actions show that add-on products, such as identity protection and credit monitoring, provide little real value to consumers and are being deceptively marketed. In addition to taking action when issuers push products on consumers without their knowledge, we urge the CFPB to assess whether these add-on products are unfairly or predatorily priced given the minimal value that they provide. The Card Act also limited the total fees that issuers of fee harvester cards can charge. Those issuers, however, are still charging exorbitant upfront fees that can eat up more than half of the available credit before borrowers even use the card. Since fee harvester cards are targeted at low-income consumers with low credit limits, the high upfront fees can trigger inadvertent over-limit charges. The CFPB should, to the extent possible, restrict the total amount of upfront fees issuers can charge to 25% of the total credit limit. Finally, many consumers cannot qualify for credit cards and look to high-cost, small-dollar lenders to access credit. We look forward to the CFPB's rules regulating this market. Our experience in Illinois demonstrates the importance of enacting consumer protections for all high-cost, small-dollar loans, not just balloon payment loans. After Illinois regulated small-dollar balloon payment loans in 2005, Payday lenders began offering longer-term installment loans with high APRs to get around regulations.
Thank you, Mr. Cowan.
Thank you.
Lucy Milani.
Thank you so much for the opportunity to talk to you today. My name is Lucy Milani, and I serve as the Senior Policy Associate at Heartland Alliance for Human Needs and Human Rights. I also coordinate a statewide coalition called the Illinois Asset Building Group. My testimony today is on behalf of IABG. It's a statewide coalition made up of organizations providing and advocating for financial empowerment opportunities. As you consider credit issues today, we ask that overdraft and credit be prohibited from prepaid cards, a product that many of our participants utilize. Consumers able to manage credit can access checking accounts, credit cards, and other credit products. For those who cannot, prepaid cards need to stay a safe option. Furthermore, allowing credit features on prepaid cards will diminish the impact of state payday and usury laws and existing military lending protections. Payday lenders could use the prepaid cards to avoid rate caps and make payday loans in states where the loans are illegal. Finally, under no circumstances should overdraft be allowed on a prepaid card. It takes away from the nature of the product, and as we've seen with other banking products, can be an abusive fee for many consumers. We understand that issuing rules for prepaid cards is a priority for the CFPB. When you do issue rules, we strongly urge you to prohibit credit products and overdraft fees on prepaid cards. Finally, we do want to say that the Consumer Complaint Database has been extremely helpful in identifying problematic practices for a number of financial products, but we would like to see the CFPB expand the database to include other products like payday loans, consumer installment loans, and auto title loans.
Thank you, Ms. Milani. James Ruddock. Angie Robertson.
Thank you. I am a private consumer attorney, and I file cases under the Fair Debt Collection Practices Act. I have experienced with many of my clients that there are, as Director Cordray explained, legalese in the contracts they sign with the credit cards that contain binding arbitration agreements. And I understand that part of the Dodd-Frank Act required a study on the use of arbitration, and so I would encourage the members of this panel to set a date and educate the public on when that study is going to occur.
Thank you, Ms. Robertson. Jerome Lamette.
I represent 15,000 seniors and disabled individuals who are drowning in debt. A little history, you'll understand what I'm going to recommend here. In 1998, I was a Chapter 7 bankruptcy trustee, and I saw people who could not afford a bankruptcy who were being abused by the debt collection industry. So I started a substitution for bankruptcy, which is Debt Counsel for Seniors and Disabled, which you will find on the internet at debtcounsel.net. But my comments are as follows. A little bit of history. I spent 27 years with the Federal Trade Commission. I was the Assistant Regional Director here in Chicago, and one day in the 70s, I got word from Washington that I was to attend meetings in the 4 states I was responsible for. What were these meetings? The meetings were with the legislators who said in the banking industry, the banking industry came to the legislatures and said to them, we want you to exclude from your usury statutes credit cards. And don't worry about them going too high. Competition would keep them low. I went back to my office, I called headquarters and said, don't believe this. They're going to skyrocket. Right now, my average client income is $1,200 a month. Their credit cards are 23% interest. They can't pay them. That's loan shark interest. What I think is the most important thing right now is for the Bureau, for the government to consider returning to the 1970s. In the state of Illinois, if I want to lend you money, the most I can charge you is 6% instead of the 23% that the credit card industry is allowed to pay. So I think we are completely ignoring the fact that we've got to repeal what happened in the 1970s and return to the usury statutes, which incidentally are as old as the Bible.
Thank you, Mr. Lement. Ruth Elzey. Teresa Amato.
Good afternoon, and thank you for coming to Chicago to hold this hearing. My name is Teresa Amato, and I'm the Executive Director of CitizenWorks and its Fair Contracts Project. And I wanted to comment on Director Cordray's 6 categories of transparency that still need work, and hopefully put a 7th one on there. And that is, to echo the comments of this consumer advocate here, some of the terms that are not directly related to fees or pricing, but do have an impact on consumers everywhere, such as what are the dispute resolution mechanisms? Is there binding forced arbitration? What choice of law applies in those circumstances? What exactly is the contour of a unilateral modification provision? For example, can they just change the terms at any time, and how and to what extent, and why do we have these kinds of provisions in these agreements? People can't find them easily, and I'll give you just an anecdote. In February of this year, I was trying to find out the terms of a big bank's dispute resolution mechanism, and I went online. I couldn't find it. I could find the fees, the APR, all that. I couldn't find the dispute resolution mechanism. I called the online specialist. I was told that there's an international agreement, and so all MasterCard, Visa had forced arbitration in their agreements. And then I said, well, I'd like this particular contract. And I was told I had to go to my local bank. I went to my local bank. It took them an hour and a half to find out what was in their contract. They didn't actually have a copy of that contract for that credit card in the bank. They had to call up the food chain of a large bank, and still they said, well, we think it's a case-by-case resolution. I said, I highly doubt that. And I'm a lawyer, and it took me 2 hours to figure out. Finally, the organization that offered the card was able to tell me a week later.
Thank you, Ms. Amato. Appreciate that. I'm going to try Ruth Elzey again. How about James Ruddick? I'll take this opportunity to remind folks that our Consumer Complaint Center is taking complaints today. You can reach us at 855-411-2372. You can follow online at consumerfinance.gov by U.S. mail or fax. That concludes the field hearing at the Harold Washington Public Library in beautiful downtown Chicago. Thank you all for taking the time from your busy days to join us here today. And thank you all who joined us by live stream. Have a great afternoon.